Hello, your mortgage man Dan here, coming to you with your Monday Mortgage Minute for the week of March 20th, 2023. Now, I want to share a couple of things. Right now is spring break for a lot of people, which is awesome. And if for some crazy reason I am not your number one mortgage person to go to, and your number one mortgage person has taken some time off for spring break to recharge and re energize, awesome for them. And if you're still working and you have someone that you want to get approved, call me, text me, email me with their information. I promise to make you look good for doing so. I'll reach out to them and get them approved ASAP in your car, hopefully this week, and maybe even under contract this weekend. Let's make it an amazing spring break together. And with your Monday Mortgage Minute, what I want to do is I want to answer a question that I hear all the time. What's going on with the market? Is there a bubble? Is the market going to crash? Well, let me share with you some thoughts. Here's why the housing market is not going to crash. Today's housing market is way different than it was in 2008. It used to be easier, significantly easier to qualify for a mortgage. And now lending standards have tightened. So today buyers have to be much more qualified than they were in the past. And it's really a good thing. If we take a look at the historical data from the Mortgage Credit Availability Index, you can see in 2008, 7, 8, 9, it was the Wild West. Money was being given away to anybody that could really fog a mirror. That's the way things were back then. Well, you can see that things changed very suddenly, and now things are back more towards normal, where buyers have to qualify. It's really three ingredients: income, assets, and credit. That's what it takes to get a mortgage. And you need at least one strong pillar, ideally at least two, but in a great world, all three strong. But really, you must be qualified to get a mortgage nowadays. Because of that, the number of foreclosures has declined over time. If you take a look here at the foreclosure starts, back in 2007, right here's where it started, first quarter of 2007 through the fourth quarter of 2010, the number of foreclosures ranged from about 300,000 to about 600,000 starts, right? That's crazy. If we take a look now from 2019 first quarter through the fourth quarter of 2022, we're at fewer than 100,000 starts, right? So we are in a much better place now. Their foreclosures are not even close to what it was back then. At the same time, there's an undersupply of homes available, which helps keep prices from crashing, right? Because really, uh, the basics of supply and demand are that when there's lower supply, there's higher demand. Higher demand means higher prices. So that keeps prices from crashing because there's limited supply, there's upward pressure on pricing, which keeps the market from crashing, right? If you take a look here, the average month supply of homes for sale, 2007, 8, 9, 10, was about 9 months of homes for sale. And today, from 2019 through 2022, we're at about 3 months supply. So that is a much better position for us, especially in this kind of market. Home price gains have resulted in near record amounts of equity, and that puts homeowners in a much stronger position. If you take a look at this graph here, total US homeowner equity from 2007 through 2022, during the housing bubble, there was about $1.3 trillion in equity that homeowners had. Now we're more than double that. We're $3.1 trillion in equity. So what does that mean? If something happens and someone is unable to continue making their mortgage payments, what it means is that in all likelihood, they have enough equity to sell their home, pay off their existing mortgage, and take out equity so that they can put a down payment on a more affordable home, potentially start renting, relocate to a more affordable area, whatever it is. People are in a much better position today than they were in 2007, 8, 9. If you're concerned about a crash, call me, text me, email me. Let's talk. I'd love to discuss more in depth with you about why this time is not like last time. All right, I am here. I'm on your side. Let me know who you know I should be talking to. And like I said before, I promise to make you look good for connecting me. All right, any questions, just let me know. Your mortgage man, Dan, I'm on your side. Bye for now.